Accounting firm KPMG says global deal making could hit a record $6 trillion by the end of this year as businesses take advantage of low borrowing rates. In their latest survey, they found that nearly half of U.S. CEOs have a high deal making appetite and plan to undertake deals that will have a significant impact to their companies, with growth, of course, being a top priority. Here's a hiccup, though, high valuations. Joining me now to discuss is Phil Isom. He is global head of M&A at KPMG. Phil, it's good to see you, and this is not getting the headlines that it normally would. Why do you think that the deal-making boom has been kind of under the radar?
Well, Kelly, there's a lot of competing headlines these days, but certainly what we're seeing at KPMG is, and across the globe, is that the market is extremely strong. M&A activity is rebounded from the pandemic for sure, and really hasn't stopped at all.
So we said this is being driven by growth. In the past, sometimes it's been driven by cost cutting. We go through cycles where there's not a lot of top line growth and companies have to grow earnings by sort of combining and then cutting on the expense side. Tell me what's different this time.
Yeah, well, certainly there's a universe of companies out there that are facing some headwinds, right? We know about supply chain difficulties. We know about lack of inventory. Those issues are certainly impacting a number of companies, as well as availability of employees. And so what companies are looking for is other ways to grow. And as a result, I think our KPMG survey has found that the vast majority of CEOs see inorganic growth as the best path forward. When there aren't really great organic opportunities.
That's interesting. Also, I wonder how much liquidity is responsible for maybe offering deal makers and private equity and other players the incentive to want to get this done.
For sure, right? I mean, if you look at low interest rates, attractive financing markets, private equity dry powder at record levels, corporates with massive cash on their balance sheets, there's no doubt that. That is fueling this market as well and driving the record values that we're seeing.
What kind of industries and sectors are we talking about, and how much do we expect this to either continue into next year or kind of, I don't want to say hangover, but is there some kind of reset that we should be expecting?
Yeah, well, I think, Kelly, what I'd say is KPMG and the nature of our services, right? We tend to get hired early on in a deal process. And so we tend to have a window of visibility as to what's going to happen over the next few months, absent any major shocks. And what we're seeing both from the M&A side, our deal advisory and strategy colleagues, is a really high demand for our services. And I don't expect, absent a shock, I don't expect things that will change as we go through into 2020 or 2022. Sorry.
Except maybe high valuations. How much does that complicate things when people are looking around and they're saying, and I hear this even with smaller players looking to combine, these have cascading effects up and down across industries where people just say, these valuations are too high.
Sure. And what we're seeing are record valuations. The combination of the huge tailwinds that we discussed, coupled with a universe of buyers that far exceeds the number of assets that are out there, is really driven multiples up to levels that are approaching levels that haven't been seen, and that's causing them to really have to think about other ways to extract value. Right, the typical synergies may not be enough given the multiples that they're paying, and so what we're seeing at KPMG is just this huge demand. Not just for the upfront financial due diligence, but also for the post-merger integration work, and that's something that all these companies are going to face, paying the multiples that they have to pay today.
Shepard Smith here. Thanks for watching CNBC on YouTube.